with altcoins as well, we have to discuss staking. Now, Bitcoin is a proof of work network. You can't stake your coins on there. And the reason why Satoshi made it like that is to differentiate owners of the coin from operators of the network. It's a very, very important distinction to make sure that the network itself remains credibly neutral and competitive, and that the owners of the coin can't own a lot of them and then control what the network does. And it's a kind of differentiation or a split, a separation of ownership and control. And the network is designed to make sure that no one has control and there's no staking. If you want to earn Bitcoin, you have to work for it. You have to put out work yourself and earn fiat currency and then swap it for Bitcoin. Or if you want to mine Bitcoin, you have to work for it. You cannot create it yourself. That's very different to altcoins. And that's why they always are compared to equity, or otherwise known as securities. It's because human beings can snap their fingers and create them. And Bitcoin cannot be created like that. You have to work. And there's a big distinction between that. So let's look at altcoins and staking and inflation and what all of this is. So tokens have inflation, and that means they start off in a very small amount. So they'll start off with 100 million tokens, and they will inflate. That is, the protocol will create new tokens every day or every 5 minutes over a period of time to come up to some number in the future of something else, 10 billion. Like Solana actually doesn't have a cap on its supply. It just says, at the moment anyway, that its inflation is going to be eventually, it's around 6% right now, but the inflation will come down, but it will be 1.5% in perpetuity. Now, they may change that in the future or not, I don't know, but that's what it is now. Why? Why are they inflating? Why is the token inflating? So that comes back to how these altcoins exist and why many Bitcoin maxis, of course, call them shitcoins because they don't see them as money. Now, these aren't money because they're created by humans and they are sold to investors. So that's where it gets a little bit more grey area. So you have a token at the start and you have 10 million tokens or 100 million tokens. You sell some of those to investors. Why do you have inflation? Because you need to pay for stuff. So a project, a blockchain project is, a group of people that are doing something, and they're doing that because they want to earn money. They want to earn money by creating a network or creating an application and charging you fees for that, right, to use it. So the inflation comes in because they can't just have all of these tokens out there initially, right? They need to have them over time because, of course, they want to feed them into the market over time to fund their growth. So the initial amount, they'll have that, they'll sell a bunch of it to early investors, keep some for themselves, right? And then over the next 20 years, you can see the inflation, right? It just starts to go, it goes higher and higher and higher. So every 5 minutes or every block, that will come in with some new tokens. Who's owning those tokens though? Well, it's the people that own these. These people own a certain percentage of the protocol, and when you stake that token, you get the staking rewards which will be paid out. If you're early investors, you may also have specific different lockups. For example, you can see here that some protocols, what they do is there'll be early investors that are promised more tokens over the next 5 to 10 years, and they get those tokens, every week or something. Well, that's adding more tokens into supply, which is inflation, right? So essentially why inflation exists is because you have investors that want to have those tokens given out to them for free so they can sell them for money. Now, that can be fine or it can be nefarious. The first one is you're a project, you have no money. So you need to sell the tokens to get dollars to pay for the project to get built and to pay for developers because they want actual money. They don't want these tokens, they want dollars so they can pay for their house. Over time, you know that you're going to need to stay competitive and have even more money in your coffers to pay for even more development. And so you take these types of things where you get staking rewards that come out to you 5% a year. So you know, as an early investor or a project, that you own 30% of this project, and 30% more coins, or 5% more coins are going to be coming in every year for you that you can use to sell for dollars to fund the project, or just sell and now you're rich. So that's why token inflation exists. It's the same as equity, right? If you've ever been in a company that has done a share placing or sold equity to investors, they're creating equity out of thin air. They're selling it to you for money because they want to expand their business or do something like that. Or, what happens in larger companies is that CEOs and managers will get free stock options, which means they have options over stock, so they can buy them cheap and sell them for what the market price is, and that's like a remuneration package for them. So you can see the mix here between, these aren't money. These are some sort of like equity investment, but they're not equity, they're tokens. They're definitely not equity, they're tokens, but they have a mix of this kind of equity thing in them. So that's why inflation exists. You need to pay for development over time, and of course you need to pay for security over time as well, because you need people to stake. Inflation is a bad thing, right? Inflation means that your percentage ownership of the protocol is getting diluted all of the time by inflation, just like the US dollar is. So inflation isn't good, it's something bad, and we need to protect ourselves against it. Most tokens will have inflation because that's how they start out. They start out small, they need to bribe people or pay them these tokens to get them to do stuff like join the network and stake, right? So it's not a good thing. We need to make sure that we aren't in a token that has very high inflation. It's just debasing our currency all the time. So some tokens will cut the inflation off that have it now. For example, Bitcoin and Cardano. Cardano and Bitcoin have a cap on supply. Bitcoin is 21 million. Cardano is 45 billion. And so they have inflation as the network is growing, but their outcome eventually is we won't create any more coins. And we have to make sure that the network is profitable enough through fees to secure itself. Right, so that's their thing. Some tokens will never reach maturity and they will simply devalue. Right, because they have inflation, the fee generation isn't enough, and so they're just going to inflate over time and become less valuable versus things that are more valuable, more popular, and have more fee revenue. Right? Now, we are entering a stage of some maturity in the industry where some projects are very profitable. So, for example, Ethereum. Ethereum is extremely profitable. It makes a lot of fees as a network. And what it does with those fees is it returns a lot of that fee revenue to investors in Ethereum, where you can stake your coins in the network to receive the fee revenue. And so what happens is, you can see that here, this is buybacks and dividends. So just like a business which wants to create shareholder value through its profits, it has a business, it earns profits, and it takes the cash that it has, which is worthless, and it buys back its own stock. And that takes money that it earned and increases the value for shareholders because it buys back the stock, and so it buys back and cancels the stock. And so now there are fewer shares sharing the value of the business that pushes the share price up for each of the remaining shares. That's what Ethereum does as well. That's what BNB Chain does because it's profitable, and a few others. So that's a share buyback, but you call them a token burn in crypto. It's the same thing. Now here you can't see it, but it's right here. It says dividends. Companies pay dividends where they just earn profits and they've got nothing better to do, so they just pay you cash. It's like, we made this money, here's some of it. Right? And you can do what you want with that. You can either roll it back into the stock or you can take it out. The way that crypto tokens do this is through staking rewards. So let's say Ethereum is earning billions of dollars in fees. In Ethereum, the gas fees are paid in ETH. And so what it will do is just pay some of that out to people that stake. So what can happen is, after a month or so, you'll have more Ethereum in your account, more Ethereum in your staking account. Now, staking Ethereum you can do with different organizations. We won't get into that now, but essentially if you are staking ETH, you'll be receiving more ETH, right? And so that's like a dividend out to investors. So again, you can see there's a lot of similarities with equity here, but Ethereum definitely isn't an equity. It's a network, it's code, right? It's definitely not, but there are many similarities. But the underlying is that, value is returned through a very simple method, right? If something makes money, you have to return it either through reducing the supply of it or just paying out the cash that's made. And we call it token burns and staking rewards. Inflation is used by early investors to dump on you. So what happens now in crypto a lot is that obviously everything is venture capital funded. Now venture capitalists, what usually happens is they'll put money into a business or something else, and then they'll have a lockup period of like 5 years. That's very common. What's happening now with crypto is that they actually don't care about that because they can have staking rewards. So let's say you have 30% of a project, and let's say that's $100 million. And let's say you're locked up for 7 years, and so you can't take that out. That's not great for you as an investor because you've got money locked up that you can't sell. But the staking yield is 6 or 7%. Well, that's a way of getting money out of the project because you're now making 6 to 7% on $100 million paid into you in fresh tokens and cash. You can actually sell that out. So, yeah, inflation is used by early investors to dump on retail investors who are sold tokens for some reason. Hey, look at this shiny new token. You're going to get rich if you buy this. Meanwhile, you buying it is through the supply of early investors who are selling out their staking rewards. So that's something we have to be aware of as well. What we need to look at is fully diluted valuation. It tells us how much is left to dump on our heads. So let's have a look at this. Bitcoin has some inflation left. 19.6 million coins, 21 million total coins. So there's some inflation left with Bitcoin. We look at Ethereum. You can see the circulating supply is 120 million. Total supply, 120 million. Ethereum is deflationary or disinflationary now because fee revenue is enough to sustain it, and so we're actually getting real rewards out of it. If you look to something like Solana, I think Solana basically has no max supply. As you can see here, it's infinite. There'll be at least 1.5% new coins every year. At the moment, it's around 6%. If you look at something like Cardano, 45 billion max supply, 35 billion in circulation right now. So let's go down to something like Polygon. You can see that Polygon is number 16 in the rankings. It's worth 8 billion as of making this video. And you can see the fully diluted valuation is $8.5 billion. That's pretty good, right? So what we know is that most of the supply is circulating, right? Because the market cap is 8 billion and the fully diluted is 8.5 billion. So we know that there's actually not a lot of inflation left in this coin unless they change the rules or anything like that. Well, that's number 16 in the market cap rankings with a valuation of around 8 billion. So if you come down here to something like Arbitrum, this is valued way lower than Polygon, right? It's number 38 in the rankings, not as big, obviously, not as valuable. It's only worth 2.6 billion. But if you look at the fully diluted valuation, it's worth $21 billion. So this project actually, when you take the total supply, is extremely highly valued. This would actually be like top 6 coin. Why? Because there is a tiny circulating supply. So we take the market cap, like I said, by taking the price per coin and multiplying it by the circulating supply. There, only 12.75% of the total supply is in existence. There are millions and millions of coins left to sell and dump on us. Why? Arbitrum is a new project. It's fairly new, maybe like a year or so old in the public market. They are new. There's a lot of infrastructure to build, and so they have a lot of tokens that are held up in order to dump and sell for dollars so that that project team can be competitive and build competitive products. It's not to say that's a terrible thing. there's no other way to do it, right? You can only raise a certain amount of money when you're very small and you have no product. You can only raise venture capital at that point, right? Venture capital is like, here's 2 million per project. We'll put it in, and you know what venture capitalists are like? They'll spread that around. As a project that doesn't have a product, you simply can't raise more money than that. So you have all these tokens because you build the project, you make it a bit bigger, and then the value grows. Then you have equity in your token at that point, right? You have money now because people are willing to pay a higher price. And so you can sell to make the project even bigger. This is how capitalism works, how venture capital and public markets work. You're seeing it in real time. But don't get caught out thinking that, wow, Arbitrum's really low valued here. It's not. It's worth $20 billion. And so they are going to have to really build out very important services to justify being valued at $20 billion fully diluted, right? So what we would hope is that as they sell out all of these tokens, give them out for projects and incentives and everything, this selling supply gets absorbed by buyers who are simply willing to pay the current price because this project is seen as profitable and good and big and sustainable. So something to think about when looking at altcoin valuations. A great resource is Token Terminal. You can see what tokens earn how much and if they're returning it to you. So this is one of the resources I'll link down below in the description. So Token Terminal, you can see 180 days here. Over the last 180 days, which tokens have earned money? Ethereum number one, you've got $1 billion here. So Ethereum's earned $1 billion as a protocol. Bitcoin is up there. We'll never return any of this to investors. That goes to miners. But it's a profitable protocol, and that's important for Bitcoin as well for its longevity. You have Tron here, Lido Finance, Uniswap. So all of these are essentially Ethereum DeFi, MakerDAO, Aave, Avalanche is its own chain, right? Curve Finance, PancakeSwap, GMX. These are all DeFi applications, right? So trading, investing, derivatives, things like that. They charge a fee for people to trade on there, and so they make money, right? So they're good businesses, and they make, they've made $50 million, they've made $58 million. So there are some profitable businesses here. Obviously the difficult thing comes with the base layer assets, because these are not just businesses, these are not just profitable, these are also base layer assets, which means you can collateralize them, you can use them as a store of value, you can put them in protocols to get other things, right? So base layer is kind of a little bit different, but with the applications, these are just businesses in my opinion, right? GMX is a derivatives protocol. People trade, GMX charges a fee. How much do you earn now, and what is the valuation of your business? If your valuation, if your total market cap is anywhere from 10 to 80 times your revenue, that's kind of okay as a tech investment, right? These businesses will be valued very highly. 50 times, 80 times their fee generation would be normal, because they're expected to grow a lot larger. They're not cheap. Some will grow and some won't. So again, it's difficult, which is why when people invest in equities, they diversify, because they just don't know. When you diversify, what you're really saying is, all right, here's 20 of the best businesses in crypto. Let's just put all these into a portfolio, and that's, 5% of my portfolio, right? So you've got this, you're not investing in one thing, you're just investing in DeFi. You're investing in, crypto. And that's what you're in exposure to. So what we have to look at also when doing that, I'll get to this in the investing section, but you need to look at, what one of these assets is performing against ETH. Because ETH is really a decentralized or kind of a diversified way to invest in everything built on top, right? Cardano is a diversified way to invest in everything building on top, because they all eventually pay fee revenue. So a question to ask yourself is, do I need to invest in these altcoins, or can I just get exposure to all of them by just buying the base layer asset? Everything's going to feed down to that base layer asset, and is that the sweet spot for me, risk reward? It's bigger. It doesn't matter if 7 of these businesses fail, because some other ones will come along and use the network, and that's fine for me. So there's just questions that you need to ask yourself when going into altcoins, but Token Terminal is great. You can see exactly what each of the protocols earns. Now a quick note on staking, because if you own any of these coins that aren't Bitcoin, they probably allow you to stake. And so what is staking? Well, it comes in line with inflation, like I said. If you stake your coins, you receive staking rewards. Now, staking rewards come from 2 places. One is inflation, right, which is the protocol just creating new tokens out of thin air and giving it to you if you stake. And the other is through fees, or more accurately, profits, right? If the protocol, if the blockchain or the protocol, whatever it is, that token, they're doing something, they're earning money, they're earning fees, and they're paying everyone, and then profits are made, that can be returned to you. Now, the way you do that with all tokens is through staking the tokens. So if you've got ETH, you stake Ethereum directly on the blockchain. There are many other providers that let you do that as well, very easily. I've got specific videos on staking across all blockchains, so they'll be listed below as well. Staking, though, is sometimes mixed up with lending or DeFi. This is not lending or DeFi. Real staking is where you take the layer 1 coin, you stake it right on the blockchain. And so that is not lending or anything like that. It's a blockchain protocol that should, pay you back, right? Now, there are other things that happen with staking, including slashing. We won't get into that for this video, but generally, as long as your stake is with a validator in the network that is running properly, you should be receiving those staking rewards, whatever they are. So, obviously, inflation isn't good, right? We know that inflation, that's not good to have. And what we want is staking from real fee generation. So, layer 1 networks use staking rewards to incentivize people to stake because it's a security mechanism on the network. And so they need inflation initially for that. After they're mature, they should be generating fees and profits that actually pay you real yield. So what we know is staking rewards minus inflation is the real yield that we get. So staking rewards minus the rate of inflation is the real yield. So let's take an example of, we have 5% staking rewards for our token. And 5% of that is paid out through the inflation of new coins. So we're staking, we're getting 5% more each year. Our real yield is actually 0. Because our new coins or tokens have been paid out to us through the creation of new coins. And so the net effect is that no one's got any richer. It's why inflation in fiat currencies makes them less valuable as well. Because you can't create real output by printing money, right? You can't do it. You can't create a doctor by printing money. You have to actually, educate them over 30 years. Real work. You can't pay real yield by creating tokens out of thin air. You need to have profits and pay them out to people from the actual work that you did. So if staking rewards are 5% and the inflation is 1%, then our real yield is 4%. We know that 1% of inflation is taking out, but there is some real yield there. So what we can also determine from that is that if you are not staking, but there is inflation in the coin, so let's say a coin that has 5% inflation every year, and you can get that 5% through staking, but you're not staking, you are getting debased by 5% a year, which is exactly the same as what fiat currency does. Now we come to a quick primer on trading before going ahead and actually seeing me trade live, so you can see everything and how it's done and how to navigate a screen like this. Currencies are traded in pairs. All assets are traded in pairs. You need to sell one thing to buy another thing, right? And so you need value. You need to spend that value to get the other thing that you want. This is an exchange of one thing for another. The way that we look at that and trade that is like this. So what we have here is BTC / USDT. what we're saying is we're trading Bitcoin against a stable coin, US dollar stable coin. We're trading Ethereum, ETH, which is the ticker of the asset, which is the 3-digit code or 4-digit code. And we're trading that against US dollar Tether. Or you can say we're trading Bitcoin against ETH. So you just need one, you need to sell one, and you need to buy the other. The base currency is the main currency that you're buying. That's on the left. So what you can see here, these are the base currency. The quote currency is the currency which you're selling. So that's this one. That's the currency that is using to quote the base currency. How that works is that it tells you how much of the quote currency do you need to buy 1 unit of the base currency. So you have the base currency, which is BTC. How much of the quote currency do you need to buy 1 unit? If we see a price that is this, BTC USD 50,000, we know BTC is the base. We need 50,000 USD to buy 1 unit of BTC. If it goes up like this, we now need 55,000 USD to buy 1 unit of BTC. The price has gone up 5%. The BTC USD pair is up 5%. That means the base currency has accrued in value by 5%. It takes 5% more of this one to buy the base currency. What we're doing when we're buying assets is we're selling our fiat. And so what you're inherently saying is that this thing that I'm buying will be worth more when I come to sell it next time, right? And so what you're saying is which thing are you selling and which thing are you buying? Because that thing you're buying, you think it's going up in value. You're basically betting on one thing versus the other. It's not just an investment in one coin, you're selling the other thing, right? So you're inherently saying that the thing you're buying is going to outperform the thing that you're selling. So yes, you could be selling fiat currency into Bitcoin, but you could also sell Ethereum into Bitcoin if you think Bitcoin's going to outperform over the time frame of that trade. Could be a week, could be 10 years. When you buy crypto with a fiat, you're betting against those fiat currencies. Now, fiat currencies go down in value over time. We've got hundreds of years or thousands of years of history of that. And assets go up in value. So that's a pretty good bet. It's pretty safe bet. I mean, as long as you're buying an asset, right? This is the most basic strategy. Currency pairs change though. When we look at cryptocurrency, we always quote the dollar price. So you can see here, Bitcoin's 46,000, Ethereum's 2,600, BNB's $300. But of course, many of us don't trade in dollars. We trade in other currencies. This is Bitcoin versus some assets. So this is against pounds. So it's gone up in value versus pounds. It's gone up in value versus euros to more or less the same extent. That's because pounds and euros have devalued versus BTC more or less the same extent. Except against Argentine peso, it's really gone up in value. And against the Turkish lira, it's really gone up in value. So it really depends where you're coming from, right? If you earn in pounds or dollars, then, Bitcoin is outperforming those. But if you earn in lira or pesos, Bitcoin is extremely outperforming those. But Bitcoin's the same thing. So what these charts are showing is the weakness of the quote currency. Now let's come to actually how to navigate this as well. So on the trading screen, which you can get on TradingView for free or some of the crypto exchanges, which I'll go over in the next section. But we have a screen of two currencies. So up in the trading screen of a crypto exchange, I'm using Bybit here, BTC USDT. So what we're looking at is Bitcoin against US dollar. And we can see right here, this is the chart over time. So let's go to a week chart. This means that we're looking at each period in time to be a week. And you can see that over recent history, the price has gone up. What we're saying is it takes more dollars to buy Bitcoin. Bitcoin has accrued in value, right? How do we know that? We can see this as well. So this is the order book. This is the actual market for this currency pair right now. The order book is simply a book of orders. That's why it's called an order book. It's the orders sorted by price. So up here you have sellers, and up down here you have buyers. These are cheap, these are expensive. Where they meet in the middle, this is the real live price of Bitcoin. This is the price of Bitcoin that is actually being traded. People are selling and buying Bitcoin in USD. Down here, we have bidders or buyers. So the bid is the half of the book that is buyers. So we call this the bid, right? So they're bidding for Bitcoin. So if you're a buyer, you can join the bid and you can bid for Bitcoin. There is also the other side, which is sellers. This is known as the offer. These are offering out their BTC. If you're in America, it's called the ask. So you can offer, right? You can offer out your BTC. This is the ask on this side of the order book. So down here we have the bid, and this is the ask. In the middle, we have the actual price of BTC. Now, between the best bid and the best offer, so the highest bid and the lowest offer, that is different, right? If I was to bid $50 for something and you were selling at $52, the spread is $2. That's the spread between the best bid and the best offer, highest and lowest. The spread is the difference between that. This is a cost when trading. So when you buy, you're buying from someone who's selling, and there is a spread between that. Now for crypto, the spread is tiny. It's literally 0.01, as you can see here. So 1 cent, I think this is. There's a 1 cent difference between the best bid and the best offer. So it's minuscule. When you get to very, very illiquid coins, tiny coins, the spread may be bigger, and that is a cost, because if you sell and if you buy and sell immediately, you have to pay that spread, right? So that is a cost of trade. And then, of course, you pay commissions and trading fees. So every time you buy, you're already immediately down by the commission that you pay and the spread that you pay. Now, this is the trading screen. So if I were to bid, if I were to be the best bid for Bitcoin, I would have to pay 42,909.40, right? That is the best bid. Where is the best offer? This is the best offer, 42,909.41. On the right-hand side, you can see what is being traded at that price. So we know that the quantity for this is here. We know that at 42,909.41, there are around 6 Bitcoin on offer. So that might not be one seller, there might be multiple sellers, but that price has 6 Bitcoin on offer. And I think this is the total on the order book. Up here at this price, we have 0.7 of a Bitcoin on offer. Up at this price, we have even less. This doesn't matter too much, because what happens with Bitcoin is that people hide their orders. They don't show their orders. They only show the order they want down here, and then up here they actually use, trading bots to put in orders if they get traded and things like that. So it's too complex for this, but essentially we're seeing the price and the amount at that price that can be traded. So you can look at that. Now again, for BTC, 5 Bitcoin, is plenty of liquidity for BTC, right? If you look at smaller pairs, you might be able to see that there's a price, but there's only a tiny amount here, and then the actual volume to be traded is further down. And that shows you the real price of the asset, maybe not this, but maybe this, right? So that's how we read the order book. It's a book of orders and a book of traders showing their trades to the market. Now let's come to the top crypto exchanges. If you are looking to trade crypto or use blockchains, you're going to need these centralized exchanges as an on and off ramp, but they're not all created equal. So I'll just go through the major crypto exchanges right now. Some of the smaller exchanges are what's known as bucket shops. They'll let you trade meme coins and these small things that, are just kind of the bucket shop type of, investments. Others are much larger and provide big infrastructure for the industry and wallets and everything like that. Coinbase, one of the biggest names in the industry, they are the only publicly listed centralized crypto exchange. That means that they have their stock market listing, they are open and public, and there's an army of lawyers here making sure they don't steal your money, right? And so trustworthiness has to be the number one thing. All of the Bitcoin ETFs and the providers there are actually using Coinbase to go ahead and buy and custody things. So big business, trustworthy. Of course, things can go wrong, but having a public, trustworthy company like that is definitely a bonus. Their products are pretty much inferior, though, unfortunately. I've used them a lot, and they just are a bit slow and clunky. Not great to use. Binance is the world's biggest crypto exchange by a country mile. They're huge. They have massive infrastructure that they support many different blockchains and everything else. They offer pretty much everything that every other exchange offers and more, and it's a very, very good product. I use Binance a lot myself. I'll leave the exchanges I use down below in the description. I can't recommend any exchanges, I just want to give you the ones I use. Now, these exchanges usually give you a bonus, or a trading bonus, or a deposit bonus, or something like that. Right, so I'll leave details of all of that down below. You can see the bonuses or whatever, and for some countries that's not available, for others it is. You're going to have to look at the links and the details in the links to see if it's available for you. But these exchanges are businesses that want our trading volume because they charge us money, right? So as long as we get a good service for a decent fee, that's fine. Binance is amongst the cheapest. You get great access to pretty much everything. Now, Binance is pretty much banned from the US because they went into the US market and they let people trade without KYC, which is know your customer information. That's not good to do. They got an investigation there, they paid a fine. Every bank has paid a similar fine, but obviously Binance was investigated and their business is profitable. You know, all funds are accounted for, so, you know, it doesn't really take them for me personally, but many people might not feel comfortable, so just putting it out there. Bybit is definitely centered more towards trading. They're all centered towards trading, but Bybit is really more for active trading. Big player outside of the US. It has huge chain support. You need chain support, right? Because you need to be able to buy a crypto and then use it and withdraw it onto the blockchain. And so you need a good coin support. Bybit has it. Binance has it. Good for trading. I use Bybit a lot too. Then we have OKX, who's number 2. Big in Europe and Asia. Very, very good for Web3 infrastructure. Huge chain support. Great trading options. OKX is actually a really great exchange with lots of different options. What are we looking for with a crypto exchange? Good fiat currency on and off ramps. Get money in and out easily. Some are better than others, and it's going to change depending on which country that you're in. So you're just going to have to check out, you know, these specific services. If you want to know how to use the exchanges and the things that they offer, I've got specific videos which I'll link below. Spot trading fees should be around 0.1%, more or less, for a trade. So the volume, the amount of your trade in dollar terms, or the amount that you buy, well, 0.1% will be taken as a trading fee. If you trade futures and options, you'll be paying under that, or at least you should be, so watch out for the fees on the exchange that you're using. These should have very good network support. If I want to buy a crypto and withdraw it on the blockchain, they need to support that network and make sure that I can do that. All of the ones I've mentioned have great support. Coinbase, a bit mediocre with that, unfortunately. The others are much better. There may be other products that you can use here, like launch pools and earn products and everything else. These carry their own risk. These are investments. They may be banned in your country because it's an investment product and it may not be available for you. Again, that's going to change country to country. These have their own risk, and so we must know that. But ultimately, we need to trust that when we put our money in the exchange, they're not going to use it, they're not going to lend it out, and they're not going to steal it from us. And so trust is the main thing, and just please trust. Like I said, I cannot, advise on what exchange to use. The ones I use are pretty much these ones that you've seen, and so I'll link them below as well. You can check them out. If there's any offers or sign-up bonuses, obviously that would be decent, but we must trust them. We must trust them. Now, the way that we can see that is what's known as proof of reserves. This is what the crypto industry did after all of the FTX thing, where each crypto exchange cryptographically proves that they have the assets that they say they do. And so Binance is number 1. It's the biggest in the industry. You can see 75 billion in clean assets here that they hold for customers. This is cryptographic proof that they're not stealing your money and there's nothing there. So they all do it. You can see that. Bybit, OKX, Binance at the top, Crypto.com, all of these. Cryptographic proof that they have their clients' assets. That is a must. If you're using an exchange that doesn't have this, just don't use it. They must be able to prove this, and this is an industry standard or becoming industry standard now. So the top crypto exchange should give you more or less these options.